Kevin, you also run a global internet ETF, a broader one than India, Next Frontier Internet ETF, and those of you keeping notes, the symbol's FMQQ, F is in Frank, MQQ, and this is exposure to internet and e-commerce sectors of emerging markets, but excluding China here. So why do we have an internet ETF that's emerging markets that excludes China? What's the thinking here?
Well, the broad thinking is that if you're going to invest in emerging markets, I am quite confident that the best way to do that is to invest in the internet companies, not just because they offer the fastest growth and the most long-term growth, but they also, in emerging markets, you've also got a huge corporate governance advantage, because corporate governance is pretty spotty in emerging markets, but the internet companies are all, not all of them, but most of them run by the founders. They've been funded by US institutions, so that doesn't guarantee better corporate governance. But so that's why we're focused on the emerging markets internet sector. Now, we have our oldest offering, EMQQ, is 10 years old. That includes China. The ex-China version, FMQQ, obviously there's a lot of people that don't want China for any number of reasons. But the other thing that's important is that, the last 10 years, China's internet companies had massive, massive growth. They're giant companies now. And it's, China's e-commerce market is 4 times bigger than all of the other emerging markets. So the next 10 and 20 years, the real growth is going to be in the FMQQ countries. That, again, I don't have any problem with China, but it's just it's a lot earlier. Than e-commerce penetration in China is 25%. In the rest of emerging markets, it's only about 5%.
And I just want to point out here some of these companies that you own. Here's Zomato again showing up, but I see Mercado Libre down there. Now that's one of the biggest companies in Latin America. That's a delivery service. I mean, is it fair to say they're kind of like Amazon, Mercado Libre for Latin America?
Sure. So yes, it is now the largest market cap company in Latin America. But importantly to mention, it's not included in the iShares or Vanguard emerging market products for some reason, but it's been the best performing stock in Latin America as well. And as with Zomato, I'll call it the Amazon.com of Brazil, and that gets you most of the way there. They are the leading e-commerce company in all of Latin America, with Brazil and Mexico being the largest part. But again, in a lot of these emerging market companies, it doesn't go all the way in describing it, because you can't call Amazon the Mercado Libre of anything, because not only is Mercado Libre the e-commerce leader, it's also the financial services leader. Its business, Mercado Pago, dominates the payments, digital payments in India. You can buy your mutual funds and stocks and ETFs at Mercado Pago. You can get a loan from Mercado Pago. So it's like Amazon, but it also has a whole other business that's worth just as much, if not more, than the e-commerce business.
Well, it has elements of almost like Alibaba and some of the big Chinese companies that are out there. You can do anything.
They're all doing the same thing.
Yeah, they're all doing the same thing, exactly. Any other one you want to highlight here besides that particular one? Again, Zomato.
I think I saw
C Limited is your largest holding here, at nearly 10%.
That's a Southeast Asian internet leader. It also isn't in the iShares or Vanguard products. The reason is that their headquarters are all in Singapore, which shows up in the database as a developed country, but their revenues are from Indonesia, Vietnam, et cetera. And all of these companies had big declines in 2021 and into 2022, but they've all, not all, but the majority of them have come back pretty strong. They've cut costs and got growth back. So it's been a pretty good run kind of across the board, with China getting a little pop late in the year because of the government initiatives.
Okay, Todd, let me just broaden this out a little more. Give us your perspective on international investing in 2024, just on a price return basis. It looks like it was a good but not amazing year. The U.S. just blew out everything here. So I see Germany up, Japan up, China's up, depends on how you measure it, but the broad China indices seem to be up. India, depending on how you look at it, up in the mid-teens, or in his case, in the early 20s. So here's some of the global leaders up here, and I'm using ETFs here, country ETFs. And I see others, Brazil's down, Mexico's up last year, but down this year. South Korea's down. So a little bit of a mixed picture. But what strikes me about this is there seems to be an almost complete indifference to investing outside the United States. You and I have been going back and forth about the flows. Europe have been terrible. Essentially, there's been outflows. So to wrap this into a bow, what's going on internationally?
So I think what's really interesting is the U.S. is almost 70% of the MSCI All Country World Index. Right? That is just dominant for global exposure. Everyone's throwing up their
Japan
hands.
is like 5. The next biggest one is like Japan.
Yeah,
right?
Japan, UK, and then Germany and the rest of Europe. Everyone has thrown up their hands and said, you know, forget the diversification of international, which may come back to bite us next year. Tech is so dominant that I wonder if there's going to be this mean reverting risk. And as for Europe, we've had major outflows in Europe. The region has not worked for ages, what feels like, in terms of outperformance. And new Europe ETF launches have stagnated, right? There's no more spin on the European region or single country ETFs, which I think is interesting from a sentiment perspective, right? Issuers have moved on from that. And so I do wonder if things are so bad for the European market, for the European economy, that you take a contrarian bet and maybe it outperforms next year. That's a little bit more of a value tilt, which we know has struggled. But I do think there's some light there. The
big problem for Europe is just the lack of tech companies. It's that simple. I mean, what is there? Infosys over there. You've got a couple of big semiconductor companies, SAP. There's some big semiconductor companies, capital equipment companies in Holland, in the Netherlands.
If you were bullish China for some reason next year, Europe's actually a great way to play it because you have all the European luxury names that get their exposure from there. So I think it's a less volatile way to play China in a sense.
Yeah, it's but the lack of tech companies. It goes to the lack that it's harder to do. I think innovation. The United States is still the capital of innovation. It's just easier to start companies. It's easier to manage them here in the United States. You know, it's not a lesson in you know
not something to fade, but just managing a portfolio is your exposure.
I'm with you on mean reversion. The problem is people have been waiting for a long time for mean reversion. People have been waiting a long, long time for value to come back in the United States. Have been waiting 10 years. Been waiting for years for Europe to notably outperform. Been waiting for, you know, just several years, and eventually it will happen.
Yeah.
But people kind of forget.
I do wonder. Active in the U.S. doesn't work, right? Active management, especially in the large cap spectrum. I can make the case for active management internationally because you can find those stocks in the mid caps or growing up to be large caps tier. If you're a good manager, that can outperform, as opposed to just using the standard cap weight benchmark, which is going to have a lot of financials, a lot of consumer staple type names. So maybe that's the path. Yeah,
yeah. It's a very tough call because a lot of people I know have basic international ETFs. Vanguard's, you know, Total International, basically tracks the world indexes ex-US. And they've been terrible underperformance. And I don't mean this year, I mean really since about the mid-2010s, about 2016. It was the underperformance of the global markets became very, very noticeable. And it's really continued unabated for now it's like going on 8-9 years.
I think you can meld together the case for active then, or at least some sort of factor. And you can get the India names, you can get the software names that have worked in Europe, and then these industrials that have been good.
Fascinating discussion, folks. India is a standout, so there's one that people consider, and this has really been going on for several years. India as a standout in the global markets, and some of the best people in the world. Come on, ETF, and explain why. That does it for this week's ETF Edge. My thanks to Kevin and Todd. We've asked Todd to stick around and provide more perspective on this amazing year for ETFs and his thoughts for ETFs in the first part of 2025. That's coming up on the ETF Edge podcast. And remember, you can see all of our shows on our website, etfedge.cnbc.com. Everybody have a healthy, happy, and safe trading week.